Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our weekly market update. And I hope you're all doing well. I had a bunch of questions come in from last week. We had a lot of people asking about what we thought the Fed was going to do, even though we kind of went through a lot of that last week and everything. So here's just kind of an overview of some of the questions. You know, People wanted to know, are we seeing more, mortgages come on, people applying for mortgages and stuff. That has definitely been, up. Mortgage volume has been up the highest level since January. you know a lot of this, obviously, it's quite obvious. You don't have to be into the data too much to know that when you go from like 8 or 8.4% interest rates that were the national average a little while back, down to, in the, 6.25 ish area, leading to an increase in refinances also, especially if you bought a property in the last, year to 2 years. You should definitely look at that. Anytime your, as a matter of fact, anytime your rate goes down, let's say even 25 basis points or so, 0.52%, I would refinance. I know loan officers do that. I know a lot of investors that do that. I do that on my properties, always have. So that's a great kind of gauge for you to kind of look at, because it is a huge savings when you can do that sort of thing, and you can do it with no out of pocket costs. And if you bought any properties with these buy down programs, which I'll talk more about as we normally do, you can do that with the money sitting in an escrow account that was put there by the seller or the builder at the time you bought the property, if you have a buy down program. So there's a lot of different ways to get those lower rates right now. But housing market trend right now, existing home sales are at historic lows. And that's just due to the, overall long term, this long term 2 year span that we've had of these higher than normal rates, or higher than what we've been used to for like the past decade or more. So, growth in new home sales has been observed. That's kind of a whole separate market. That's really where the new inventory comes from, because they're giving you buy down rates. I'm going to show you something incredible that one of the builders is doing right now, but they're all offering, like closing costs and buy down programs, whether it's a fixed buy down or the first and second year, or first, second, and third year are lower. It goes up a little bit each year after the first year, but you're still going to be much lower than where you are now, even at when it stops after that second or third year, and then it's fixed. It doesn't keep going up, and all that. So those are great programs. I'm recommending them to all my clients. About half the sellers right now are paying those buy down programs. Pretty much every builder I've seen is doing it. And I'm going to show you something. I've seen rates this week that came out for limited time on a special program that a builder's doing. Guys, they're doing them in the low to mid ones, low to mid ones percent. Yeah. So I'll get into that in a minute. Federal Reserve update. We went through this a little bit last week. They're not going to cut rates until September. It'll probably be anywhere from 25 to 50 basis points. Wall Street is all over them to get this done. Even ex-Fed presidents, a lot of Fed people in the Fed right now are signaling that, yeah, it's time. And they're just being very, very restrictive. They're going to stick to that model. Don't expect anything before their next meeting, which is going to be in September. They're off in August as far as that goes. I don't think we're going to see anything unless unemployment were to just completely explode. Now, we talked about this last week in greater detail. You can go back and look at that. But we had what was called the SOM rule. We had the 3 months moving average at 0.5% or unemployment rising, and that triggers the SOM rule, which basically says, hey, we're in a recession. Some people will fight us on that. Some people want to fight the numbers. We're in an election year. Surprise, surprise. All those sorts of things come into play. Don't think they don't. But it is what it is. That's the SOM rule. That triggers the beginning of a recession. Now, we haven't seen the big numbers come in unemployment with construction workers, but we're starting to see that market fade. Once all these rental projects that we talked about have been completed, which usually take 21 months, and the slowdown in the single family market to single family home market has definitely slowed down just because they're not going to overbuild. And even now they're trying to unload inventory that they have, and they haven't overbuilt at all. But nationally, and here locally, we did see a little bit of an increase in inventory, over the past several months. Nothing crazy, nothing that's going to put us in a crash. The crash bubble bros out there that with the clickbait that you may listen to out there are wrong. It's mathematically impossible in so many ways for there to be a crash because there's just not enough inventory out there. Back when again, I say this all, almost every podcast. Uh, you know, for there to be a market crash, we were back in 2008, we had people that didn't have anywhere near the equity they have now. I mean, over 40% of people right now don't even have a mortgage. In other words, they own a home, but they don't have a mortgage. It's paid off. Uh, People that do have mortgages, the average equity right now is right around $300,000. And most people have a mortgage rate that's like, sub five or sub four even. So, to say people are underwater, when you hear these percentages out there, foreclosures have gone out 300%, they've gone up 300%. Well, yeah, but we were coming out of a pandemic, a couple of years ago. So obviously, if you just go by percentages only, but then when you dig into the numbers, basically see it's like nothing and nowhere near crash levels. But the inventory, it's all about supply and demand with anything. And the supply at the time of the crash was 4 million. Right, right now we've got like 1.3 million, which is actually pretty healthy or close to healthy for new inventory coming on the market. But we're not even breaking 80,000 a week. Back then we had anywhere from 250 to 400,000 homes per week coming on the market across the country. Here locally in the Phoenix area, uh, we had like 56, 58,000 homes for sale. Right now, we run around 17, 18,000, right now, up from, up in that range over the last year and a half, 2 years. Just because things are moving a bit slower because we're kind of in a normal balanced market, which I'll talk more about here in a minute. So nothing crazy happening there. Impact on mortgage rates have dropped significantly, lowest in about 15 months. There was a little bit of volatility in the market, which there's always going to be in the stock market, bond market. So with that, and with the Fed not lowering the rates, even though the mortgage sector is ahead of that, and the bond market's kind of ahead of what they're going to do in September, they always are. We're going to see that they've already baked that in. Now, those numbers you see on TV again are the average numbers across the country. So when you see 6.3 or 6.5, then for the average and 30-year mortgage, those are national averages. Again, with mortgage brokers, that we like to work with, you're usually going to be anywhere from 25, even up to, I've seen 100 basis point difference just on your typical pricing for FHA, conventional, whatever. But if anybody's at like 6.5-ish on an FHA VA over the last year or two, get in touch with us. We'll put you in touch with the right people to get you a refinance with no out-of-pocket cost. Also, the people who did conventionals or jumbos, you might want to look at that too, because if you were anywhere around 7, anywhere close to 7, you probably could do a refinance right now if you had that in the last year or two. So anyway, we've definitely seen a little bit of a bounce back and increased activity with home loan pre-approvals and stuff. But for significant growth in the housing market, rates would need to fall below 5.8%. Those are the models for really sustained, and you need that. You need that sustained. For let's say 12, 18 months, 24 months to really see huge growth. Now, the buy down programs are out there. I don't know what it is. Sometimes, a lot of people are using them for sure because properties are sold every day. every week, every month. We're selling properties, every day, every week, every month on our team. And here locally in the Phoenix area, properties sell. Even during the crash, properties were selling, every week. So, suffice to say that your property, if it hasn't sold, it probably needs a refresher and needs a second look. We'd be happy to do that for you. If you can't find what you're looking for, you can't get with the rates you're looking for. We have the solutions for the selling and the buying side to find you what you're looking for in a property in the area. Also, we have ways of finding buyers proactively, proactively. Okay, which a lot of people just put the property on the MLS and hope it sells, and a sign in the yard and hope it sells. We do a lot of things proactively to bring buyers to you. Same thing for our buyers. We do a lot to find a neighborhood that you like, and then you let us know what neighborhood you like, what you're looking for, and we will proactively find that property that's not even on the market yet. Okay, so I'd love to be able to talk to you about that. Reach out with questions on that. But we need that sustained lower growth. Now, the solution to the lower rate solution right now are these buy down programs. And I'm going to show you in a minute some really amazing stuff on that. Uh, Economic uncertainty right now, people have asked about the election and stuff. And anecdotally, on the street, people tell me that a lot, at open houses and things like that, or people that we talk to. Should I buy now? Should I wait? Should I sell now? Should I wait? All those sorts of things. Right now is the best time to make a move, whether you're selling or buying. Here's why. Okay, think about it logically. Do you want to gain equity in the property that you want to move to now if you're selling and buying? Or do you want to gain equity in the property you have now? Now, in some cases, if you don't have much equity, it may make sense to wait. Of course, sure. Okay. If you're really strapped, you got a lot of debt, and you just need to get more equity in order to move in the first place, sure. But if you're sitting there with, I don't know, 100, 200, $300,000 in equity or more, I would sell, move on to what I want now before these rates drop more, because they are going to trend down. Okay. And when we go into a recession, guys, again, every recession, I showed this last week in the charts. I'm not going to pull them out again, but you are going to have rates fall in every recession. And so that's the one good thing about a recession is rates fall. What triggers the rates to fall? Well, the Fed right now is looking at unemployment going up. That's triggering them to lower the Fed's fund rate, which will affect the bond market, which gives us our lower mortgage rates, which tames inflation, which they were trying to do, even though they let it get out of control in the first place and printed too much money. It's just crazy how the whole system works, but we don't have time to get into those details. But anyway, when the government prints that funny money and there's too many dollars chasing too few goods, this is what happens. We had the hyperinflation, and that's just baked in. Even if the rate of inflation has gone down, it's just baked in, guys. Everybody feels it. I'm going to show you something on incomes, though, and inflation that'll surprise you. Again, it's just the data. Some people maybe have different situations, obviously, but we'll get into that in a minute. But the surveys right now is people are waiting. People are waiting. They're wanting to see what the Fed does. They're wanting to see. People have this imagination that prices are going to drop. Now, there have been a little bit of slight price adjustments in certain areas, including Phoenix, and across the country in most places. Most of the inventory is coming out of Texas and Florida that we're seeing on a national level. But those price adjustments are really not nothing compared to where we were. Like if you go back to 2019 to now, home prices overall across the country have gone up about 50%. Okay. So from that standpoint, there is no crash. Again, there may be a flattening, there may be a slowing down, there may be more of a normal balanced market. For us in the Phoenix area, greater Phoenix area, our normal is 5% growth equity gains every year. That's our average going back to the 80s. If you look at the national average, it's more of around 4%. So if you kind of take that over the last 4 years, in the anomaly years that we had, second half of 2020, 2021, the first half of 2022, we can see that, really overall, we're still ahead. You're still ahead. But yes, to sell a property right now, you're not going to get those crazy numbers. And a lot of people are just overpriced, quite frankly. on the market right now. I see a lot of properties overpriced because we got spoiled for too long, and people are just trying to get a whole lot of money out of properties that right now with the comparable sales and appraisals that are coming out and the demand level for the cost, people are just going to do. And if even if a property is really all put together, has all the things, that people want. They're even sitting a little bit longer, but properties are selling, and if it's positioned properly, we're seeing properties, selling, circumstances with multiple offers within a week or two. Other properties may sit 3, 4, 5 weeks, but again, in a lot of those cases, it's price versus condition, also how it's marketed, set up, staged, how much exposure is it really getting? Is the agent really proactively bringing people there, and so on? So we've got the solutions for all those things, but those are really where we're at, kind of at the street level. There are a lot of people that tell me, yeah, I'm waiting till after the election. Okay. But here's the thing, when rates drop, and they are dropping, they are going to continue to drop, there's going to be a lot more competition, a lot more demand, and there's going to be less to choose from. So now you're not going to get those deals that the builders and sellers are offering you right now on these seller concessions for your closing costs or the buy down rates. And you're just going to be you may be getting beat out by a lot of these other people that figured out I can get lower rates now, or rates have dropped, and I'm going to go out there and do it. I can afford it now. For every 100 basis point drop, 5 million more people can enter the housing market across the country. Not that they will, but can. Okay. Those are just the stats and the data that we know. So, Federal Reserve policy is very, very strict right now, and their approach is maintaining tight financial conditions until the labor market shows significant weakness, which it has. But they have said in the past they're watching this, but 4.5% to them, it's 4.3 in the last reading last week. 4.5 to them is kind of normal. So, you know, uh, I think we're heading up in that range though. Once they see more of that, they're gonna, rate to get to even for the Fed's fund rate, which affects the bond market, the 10-year treasury, which affects directly mortgage rates. You would need to be at a neutral level. Right now, you would need to be in the twos with the Fed's fund rate. And the split between where we are on that, to where we are, um, with the mortgage rates kind of also is a thing, because those should be about 1.75 to 2 range. So in other words, if your Fed's fund rate is at 2, you should be at like 4 or 3.75 on a mortgage rate on the average fixed rate. Okay. That's just kind of a gauge for you. Our splits are getting better. They're getting better all the time between the 10-year treasury and the mortgage rate, the Fed's fund rate and all that. But and that's great, because as they drop the rates and as things normalize, that'll be a good thing, because we'll see that just the way the market will react will lower those rates too as things go. But they really need to change it, and really until they go to neutral, they haven't really shifted and the real data world. Okay. So underwater mortgages, people are talking about underwater mortgages where homeowners own more than the property value has decreased to a 5-year low. That's the data, guys. 5-year low. This is attributed to an increase in home sales value and equity gains over the last 4 or 5 years. So yeah, I mean, Phoenix housing market, we've got a lot to tell you about. I'm going to share my screen here with you so that we can get into those details. But really quick, we talked about the jobless claims here in the forecast. So that's going to really drive this for the Fed as far as their policy. The Fed has cut rates amid stock swoons before, not this time. They're getting a lot of pressure from Wall Street. They are really they're really kind of in a little bit of a battle right now. Wills, everybody from ex-presidents of the United States to current insiders, ex Fed presidents, okay, Federal Reserve president, people on Wall Street, everybody's saying you guys are behind. You guys were behind in the beginning of all this a couple years ago. with taming inflation, and now you're behind in getting on board with lowering this. So what drives this again is the 10-year treasury. We saw, a lot of volatility this week, a lot of drops over the last week or two, but it's trending down. You're always going to have a little ups and downs and all that. So that's just the way that goes. But the 10-year treasury is what we really track. Two-year treasury is more of a daily volatility type thing. But the 10-year is what really the overall running average is really going to give you your mortgage rate and the splits between those and how that kind of all runs together. Uh, Mortgage rates finally end this week's losing streak because they had a little bit of volatility. Again, rates had dropped in the last week or so to 15-month lows. We're going to see right now, we're going to see this trend down over the next 6 to 12 months at least. Probably more into the next 18 months to 2 years. We're going to see this continue to trend down. Now, we're going to see 2 and 3% interest rates again. No, not the normal fixed rates, not for quite a while, probably, if ever. But you do have the buy down programs. So I'm gonna get into that in just a second. Incomes and housing costs have risen together. Okay, so for people who maybe bought in the last year or two, maybe they're not feeling this so much unless they got a buy down program. If they just got a fixed rate or whatever, they're not really loving this maybe as much. So but right now, again, if you bought in the last, say 3 to 6 months even, or year or two when the rates started going up, trending up, along with inflation and everything, you can look at this as far as refinancing. Okay. But now, as far as income and households, housing costs have risen together. They've been in lockstep. This is going to really kind of maybe hit home with people who bought before the rates went up, even harder. Where they're maybe like, yeah, I stayed in my property, I didn't move. I own a property, I'm gaining equity, I have tons of equity. Everything costs more, but my income went up too. I've been getting raises. Okay. People who don't have to have a lot of debt and everything, and they had steady income, they're riding this wave pretty well. People, and again, not to say that things haven't increased. Everybody's going to see a little bit of a different thing depending on your industry, your job, your location across the country. Economy right now obviously is not doing very well if we're having the unemployment we're talking about, but that's being caused, again, the Fed caused the inflation. Okay. And now they've been trying to tame it for 2 years. They were late to the party and taming it in the beginning of when it all hit. And they said it was going to be transitory. Well, it wasn't transitory. We know that. So anyway, but the data shows that, income, even though it may have lagged in some quarters and stuff and all that, and may still be lagging a little bit, it has increased. But the dollar is also devalued a little bit, and it talks about this. So again, I am not in any way trying to defend what's gone on in the economy over the last 2, 3, 4 years at all, but that's the story on the data. Now, Metro Phoenix, specifically the Metro Phoenix area, we're at 100 days closed on markets, 108 closed days on market. Still, we're just over 2 months supply, because our absorption rate has gone up, which is a good scenario here. That was way down in the 20s. Average list price and average sales price has just kind of been hanging in there around these numbers at 736 for the list price and average sales price at 542. Part of this number here for the actual sales price is the fact that we've got a ton of lower priced inventory, at least lower price for our what our market has become. Our $1 million market's pretty much going to be our luxury market. And there's just not as much, if you look down here on the bottom left, there's just not as much inventory down in those levels at all compared to where we are, let's say sub 600 or 500,000, where the majority of that is 400 to 600,000 and 200 to 400,000. So we're seeing most of that inventory there, although we're seeing the seasonal drop. For us in the greater Phoenix area, we see, spring, early summer before it gets super hot and people want to go on vacation and all that. Because for us, school's already started in most places. The first week of August, for most places, or by the end of August, everybody's in school, right? In the greater Phoenix area. I know, other parts of the country, it's not till around Labor Day or after Labor Day and all that. So that's just for us. So, and it gets super hot here, and people want to get their vacations done. They really want to be moved in, right after school lets out at the end of May. They want to be closing on their property, move in, get settled, get maybe a little vacation time in, get out of the heat possibly, or take advantage of the heat, go to the lakes, whatever, or go out of town, and then they're back to school, they're back to work, back to serious stuff and all that. Um, and then after Labor Day, it really picks up. Even here, we start to see things pick back up a little bit towards the end of the year. So some of this is seasonal, but the actives are hanging around that 18,000 mark. Pending is down a little bit, 3,300. We usually like to see this number a little bit higher. But look at the short sales, lender owned, and HUD. All the distressed type properties. We've seen the short sales are up a little bit, but look at the actual number, 59 out of 18,000. The guys, again, that's nothing. So you can't just look at percentages. Lender owned REO, the bank owned, those are actually down 15% at 27. So again, pending sales are still down. And then our closed units with that little bit of lag time are actually up almost 5%. So there's a quick look at those stats without getting too granular for you. And I can always get you guys more information on those. I can get you more information, more understanding, more data on your particular zip code or area, or even community. But the Crawford Market Index, we like to look at this because this tells us kind of where we're at in a market, supply, demand. Are we in a seller's market, buyer's market? Anything below a 90 on this index is a buyer's market. Anything above 110 is a seller's market. 100 being dead center balance. And we're at 99.6, guys. We are in a balanced market. When these two numbers are together the same, supply and demand, which basically they are by a by a 0.3 percent there, they are basically the same number. So we are in a completely normal balanced market. So things just move a little bit slower, guys. When you put your property in the market, again, if it's set up properly with the proper agent that knows what they're doing, your property will sell faster. And that's bringing you proactively buyers. But the idea here is that in general, there's just less demand, there's less supply. Right now, we're, on both spectrums, we're basically 27 points lower than where we should be on supply and demand. Okay, so that's just the data, guys. Now for the specific areas, cities around town, we have, let's see here. Fountain Hills is actually leading the chart above Chandler for the first time in a while and going up at 5%. And that is in a seller's market at 168. Then Chandler has actually dropped 15%, but still it's number 2 at 162 on the Crawford Market Index. So those are sellers markets, along with Avondale, Phoenix, Scottsdale, Mesa, Glendale, and then Gilbert, Tempe, and Peoria, along with Paradise Valley. Those are all sellers market, but those are just slight sellers market. I mean, when we were in a crazy market, guys, between, like let's say in 2021, those numbers were in 400s up near 500. So the top of our chart right now, Fountain Hills is at 162. The other ones are just basically barely seller market advantage. The other markets for Cave Creek, there's really nothing in a balanced market right now as far as the cities proper, because Paradise Valley is at the lowest level at 104. Oh, I'm sorry. Peoria, my bad. Peoria, Paradise Valley, Tempe, those are all in balanced markets. Okay. Tempe, Peoria, Paradise Valley are in balanced markets because they're between 90 and 110. Okay. Cave Creek is in a buyer's market along with Goodyear, Surprise, Queen Creek, Maricopa City, and Buckeye. So there's that data for you. Here's what I wanted to show you. This is a program that's going on right now with just one of the builders. Okay. And they are offering rates. Again, these are buy down rates, year one, year two, year three. But look at that, 1.2% the first year, 2.25 the second year, and then it stops year three. I'm sorry. Then it goes, year three at 3.2, and in this one, it goes to 4.2 for the balance of the term. Okay, so even at 4.2, guys, hello, the average around the country is 6.5 ish to 6.3 right now with the way the trend is going. We're looking at even 4.2 in 3 years at 4.2. That's kind of what we've been used to the last, decade. That would be kind of the running average probably. Because remember, those 2 and 3% anomaly years of those low, super low interest rates before the crazy stuff happened, those were like, a short period of time. That's not normal. For us, over the past decade or so, since the crash, pretty much, or since, let's say, 2012, 2013, that's kind of normal, right? Up until the last couple of years when rates went crazy. So yeah, I mean, that's a huge savings. I mean, guys, you know, just with rates going from 8 to 7, you were saving like $1,000, over $1,000 a year. So again, we can have the loan officers break this down. Now, with these builders, everyone's a little different, but they're all going to be super low. I mean, they're anywhere. I've seen stuff in the threes, fours, fixed rates, guys, in the threes and fours, along with buy down rates. This is very, very low, but buy down rates in the twos, starting in the twos, ending up in the fours, guys. This is no joke, and they are paying for this. And in most cases, they're also paying your closing costs, which are title and escrow fees and stuff, and the lender fees. They're paying for all this. Brand new, move-in ready. You can move in now, close within 30-day homes, guys. Brand new. Okay. What your payment's going to be on this? Well, depends on the price point. But I'll tell you this: whatever you're paying in rent or want to pay, for a mortgage, this will get you there. So, right now, most people, they're paying what is it? Probably I think the median average right now is in the greater Phoenix area for rent was like 2,300. Most people on the west side are paying anywhere from $2,000 to $3,000 a month, give or take a little bit. Most people on the east side are probably paying around $500 to $800 more than that. So the guys, this is a no-brainer. Okay. Waiting for a crash is not going to happen. It's mathematically impossible. There will not be a crash. There will not be a crash. There's not enough inventory, and there's not enough inventory coming from the builders to make that happen. They overbuilt in 2008. They overbuilt, and we had all these people that didn't have enough equity that got loans they should have never gotten in the first place, and they had one or two or three homes, and they couldn't afford it. We don't have those problems now. The lending practices are totally different. People have too much equity. Too many people own properties outright. There's not enough inventory, bottom line. Guys, if you can join us today, we're going to be having an open house over in this Saturday, the 10th, from 11 to 2 over in Peoria. There's the address and everything and all the details. Also, we have another featured listing out in Goodyear, and that is going to be on Sunday, the 11th, from 10 to 1. Actually, no, I'm sorry, that time has changed. I should have updated that for you. But anyway, it's going to be actually 1 to 4, 1 to 4. So sorry about that. But anyway, guys, that's all I have for you this week. I hope I didn't go too long for you. I'll break some of this down, hopefully, over the next few days into some shorter videos. But hopefully, that gives you an idea of what's going on in the greater Phoenix area. And if you guys have any questions at all, or like any solutions to any goals you're trying to reach, please reach out to me anytime and we can go over the details on this. So again, guys, looking forward to talking to you soon and have a great weekend.